All right, it's 6:05, so here we are. So I want to say thank you to everybody who's here. And we Ian is here graciously agreed to be my speaker this evening. So he is a financial strategist, I want to say. Is that a good way to
Yep.
describe you?
Perfect.
Yeah, and he has a lot of great strategies that he can teach many of us who are in real estate or not in real estate. But it seems like everybody I know is in real estate. So I think that's most of the questions that we're going to ask Ian today. So, Ian, do you want to talk about yourself a little bit and describe what you do and who you are so we can get to know, love, and trust you?
Yeah, 100%. Well, again, thank you, Cindy, of course. Thanks, Mitch, for introducing me to Cindy and to this amazing community. And obviously, thank you to everybody that, showed up. I know in the evenings, sometimes during the week, it's a little crazy. Everybody has obligations. So I promise that it'll be worth your while with the information that I give. And, I hope that everybody can walk away with at least one thing that maybe they didn't know prior to coming to the call here so that they could implement it and obviously better their situation from a tax and investment standpoint. So I am a financial strategist, as Cindy noted earlier. So I call myself a financial and tax strategist because I first of all, I'm not a financial advisor. I want to just clear the air there. I don't manage money. I'm not securities licensed. I have no intention to be. I chose not to go that route for quite a number of reasons. More importantly, because I like leveraging the resources we have available as general population, such as the tax code, to invest smarter, buy smarter, keep more of what we make. You go out there and you make $100,000 and it's like, okay, 20, 30, 40%, depending on where you're at, is taken in the form of tax. And so the tax world is extremely complex and it can be daunting for a lot of people. A lot of people are very scared of the IRS, which is crazy to me. Those three letters, right? Everyone's scared of the three-letter agencies. You should be scared of some of them, but not the IRS. Believe it or not, in on the topic of tax and financial strategy, the tax code itself is 77,000 pages or so. 95% of it is actually rules, regulations, and guidelines on how you can keep more of your money and pay less in taxes. 95% of it. There's only about 5% of it that tells you what you can't do and what would get you in trouble. So people are so scared of it and scared of the IRS agency because they don't want to get in trouble. They don't want to bend the rules. They don't want to do this. And I'm not about any of that, right? Everything's black and white, black letter law. It's either yes or no. We don't operate in the gray ever. I'm not a CPA. I'm not a tax attorney. I don't purport to be one, but I have a team. I'm part of a family office. And so I have a team of tax attorneys, CPAs, forensic accountants, financial advisors, estate planning attorneys, the whole gamut of different folks that come together to service clients from a team level. Okay. If you need a CPA and maybe some estate planning, well, we have that packaged up. Or if you need some just advice or guidance on how to not get slaughtered in capital gains tax when you sell a property or when you roll a property into another property and do a 1031 type structure. How do you do things in an effective manner to where you're not giving a bunch of your money away that you work so hard to earn? Okay. So again, I'm going to say this probably 10 times throughout the call. My favorite line in the world, and I would tell everybody is it's not about what you make, it's about what you keep. If you live in California and you make $500,000 a year, whether it's W-2, 1099, K-1, doesn't matter where your income's coming from, you're paying about 45% of that in tax without any deductions. So you're giving up almost half of all of the money you make to the IRS, to Uncle Sam. Bye-bye. And I hate to tell you guys, but once the money's gone, you're not getting it back. They don't really give refunds for people that, overpay them in taxes unless there's obviously good reason. But typically, no. They'll just apply it towards future tax bills. So I think the premise of this conversation is how do we gear financial strategy? How do we gear tax strategy? How do we gear being smart and having proper structures and strategies in place when real estate investing, when using money in 401ks and IRAs, self-directed IRAs, SEP IRAs, when using that to park it into asset classes like real estate and others, but like real estate, how do we do it to where we're not just deferring taxes and creating a larger problem for ourselves later on, but growing our money in a tax-free manner? Because I mean, I don't have to ask anybody on the call here, but I'm pretty sure if I asked the question and took a vote, who would rather grow their money tax deferred, which means you're paying taxes later, not right now, or tax free? I'm pretty sure everybody would probably choose the latter. So that's who I am, what I do. And again, you know, I don't need to get into the nitty gritty about every little piece of the equation. It's a very case by case basis. My conversations with people are very simple. It's where are you at right now? Where are you trying to get to? Do you just want to buy one property? Okay, how do we get you there? Or do you want to build a billion-dollar real estate portfolio and exit in 20 years? What does that look like? And then how do we reverse engineer and get you to that point without paying a bunch of money in taxes and without screwing yourself later on? That's that's how I solve people's problems, and that's my main focus.
That is awesome. I love to hear that. And I looked it up. I have a phobia, I think, of the IRS and taxes. There's actually a word for it. And every year I get very, 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 very stressed. I think as the years go on, I'm getting a little bit better. I'm still waiting on K1s, and my people are like, yeah, just, not get them when you get them. But I'm kind of like, okay with it this year. So I'm growing. I feel really good about it. So I hope other people are doing that as well. So yeah, I definitely want to ask some questions, Ian. So I've got a nice list here prepared ahead of time for you, and I'm going to just kind of dig into those. So,
For
what do
sure.
you think the biggest tax mistake you see real estate investors make?
Really great question, Cindy. Perfect question. And that's an awesome way to segue into this whole conversation and discussion. Real simply is they just defer and defer and defer and defer and never actually eliminate the tax issue, the tax problem. Okay. When you do a 1031, as most people who know on the call, who are on the call here know what that is, yes, it makes sense in some cases, but there are just more effective and better avenues to take to do a 1031 or to roll money from one property into another without paying any taxes and with growing your money tax free going forward. If you sell a property and make $100,000, as you know, if you 1031 and everything meets the criteria per the IRS, well, you're deferring the taxes. 2 years, 3 years, 5 years later, you sell the next property, you make 250, you roll it again. Now you got a $250,000 tax liability. Then 5 years later, you roll it again, you got a $500,000. You're snowballing and you're creating a larger problem for yourself so that one day when you decide to exit or when you pass away and your family inherits that portfolio or the assets, there will be a tax liability due. Yes, there are certain ways to structure through trusts and wills and insurance products. There's ways to structure it to avoid that issue. But why not eliminate the problem early on when it's a smaller liability, a smaller dollar amount, and at a lower tax rate? Taxes typically go up over time. You can look at history. Or instead, wait 10, 20, 30, 40, 50 years and just create a larger problem for yourself later on. It's just not efficient when it comes to truly growing wealth. Why do we buy real estate? Because we want to grow our wealth. We want to build a portfolio, build a legacy, and whether that's providing income for you when you decide to stop working, or if it's just passing down the assets and the estate to a beneficiary, let's do it in a manner where it's tax free or at least very tax efficient instead of having your family and your heirs get hit with a 40% estate tax. And now they're basically in business with Uncle Sam when you pass. Okay. So a lot of real estate investors, Cindy, when I have conversations with some that are very, very high level, say, oh, well, I don't care about tax strategy with real estate because I'm just going to 1031 in a perpetuity, which basically means for the rest of their life until the day they die. Again, there's no guarantee that your family will want to manage that portfolio when you're no longer here. That's number one. They might just sell everything. then they're taking a massive loss on everything you built because of the tax liability. Or when you sell, if you're not structured properly, guess what? The government is now a partner inside of that portfolio, inside of your estate, whether you like it or not. And that's typically at the 40% level. That's what inheritance tax is at right now. There's thresholds and different things and different criteria, depending on what net worth you're at. But the point is, it's not going to be a pretty process. And then there's probate and lawyers get involved. And why would you want to subject your family to any of that, especially after they just lost a loved one?
Yeah, I just went through that last year. But I think we did all right. And so, to your point, I am so guilty of what you just spoke about. My husband, who has joined us today and is learning a little bit about what I do, and uh, he has asked me, when are we going to stop the 1031 exchange and the perpetuity? So I am there now. So great, great point. How am I going to fix that? What am I going to do? And because
Yeah.
I am getting ready to sell a property that I 1031'd into 2 times. So
Yep.
what should I do? Can you tell me?
Yeah, and to be honest with you, Cindy, the way I would answer that question is because we can have probably another 45-minute conversation on your specific dynamic. But the way I would answer that,
Uh-oh,
there,
he's
there's
frozen.
there's probably other strategies.
He froze for a
I'm sorry,
second.
can you hear me now?
Yeah.
Okay, I'm good. Sorry about that. All right. So I would say, Cindy, there's probably a dozen other strategies that you can use instead of just the 1031 to eliminate taxes instead of defer. But I would really want to understand what your goal is. Are you planning on completely exiting in the next couple of years? Are you planning on just continuing to purchase real estate and acquire? Are you planning on getting, maybe buying a business instead? Maybe doing some other things with the money. I'd want to understand kind of where you want to be at so that I can figure out what is most applicable in your dynamic. But real simply, we have deferred sales trust. We have 1031 cash swap. We have different types of charitable giving strategies to permanently eliminate your tax liability at,
Fantastic.
at now and going forward.
Great, great, good. Well, I'm glad you brought it up. I'm glad I asked the question. So it sounds like it's a case by case scenario, but you definitely have an answer to help real estate investors. So I do appreciate that. So I'm going to move on then to the next question. So, how do you recommend choosing between an LLC, an S Corp, or trust structure for a real estate portfolio?
Okay, well, that's another great question. I think a lot of people are probably not going to like the answer, but it depends because I have to understand what your goals are. Using an LLC is nice because you get the protection of having the corporate veil. I'm sure a lot of you have heard LLCs act as a corporate veil. But the biggest problem I see with LLCs, and I've been guilty of it in the past. I'm pretty sure everybody else is guilty of it if you've had an LLC before, is the commingling. The commingling of personal and business and this and that. And hey, I'm going to take this person. Not that you're intentionally doing it, but as soon as you make a purchase with an LLC credit card, debit card, bank account that is not 100% for that business and for that purpose and for the reason of whatever the property is or whatever you have inside of the LLC, you have now pierced the corporate veil. And if someone comes after you from a tax perspective or from a legal perspective, everything that the LLC stands for and all the protection it provides is out the window. So LLCs are great, but you need an expert, CPA, tax attorney, estate attorney, someone like myself, a strategist, to help you stay on track and in compliance with everything that you're using to operate the LLC. The spending, the bookkeeping, the accounting, all of the record keeping needs to be super, super duper clean. Okay. Now, trusts, corporation type structures, right? You have S Corp, C Corp, trust. Well, that's a conversation to really have with your CPA. I'm not a CPA and I don't purport to be one, as I mentioned earlier. I do know a lot about the tax code and I have a dozen CPAs that I work with and tax attorneys who read the code for fun. So I'm very knowledgeable in terms of what the proper structure could be given a situation. But, do you have do you have one property? Do you have five properties? Do you have multifamily? Do you have single family? Are there partners involved? Is it just you? What is the dynamic? Because that's going to determine which structure makes the most sense for you. I will say using an irrevocable trust can be very beneficial when it comes to estate tax and probate when you're no longer here. Okay. That's not necessarily something you're going to reap the benefit from day one, but having your assets and having your entities and stuff like that owned by an irrevocable trust is a good start and something to look into and speak with a trust attorney about.
Okay, well, that sounds good. There were so many things on there that I'm like, yeah, that's me. So I'm really glad we're doing this tonight. What do you think the most underutilized tax advantage, what is the most underutilized tax advantage real estate investors miss? I think we all need this.
Yeah. I would say honestly, depending on if it's a short-term rental or a long-term rental, taking deductions on basically everything. Well, there's actually, I'm going to give you guys two things. Taking deductions on everything related to the property. So you buy soap, you buy paper towels, you get an inspection done, you get a cleaning done, you replace something. Believe it or not, I know it sounds kind of silly, but most people, they don't maximize the amount of things that they're able to actually deduct in terms of as an expense towards X property. Okay. You need a good record keeper to do that unless you're sitting there doing all the record keeping yourself. But I know a lot of us have other things that we do besides just owning real estate. So for me, I do not want to do my own books. It's a waste of my time to do my own books. It's like mowing your lawn or fixing your toilet. Do you hire someone to do it because it's just a better ROI? Or do you spend 4 hours on YouTube trying to fix your own toilet to save $50 instead of hiring a plumber who can do it in 10 minutes? Same thing, you know, let's just be smart with outsourcing what we're not, where our strong suits are not. The other thing I would say is things like cost segregation studies. A lot of people kind of overlook them and they don't really know a lot about them. Cost segregation studies can be a magnificent tool to, especially in the first couple of years of ownership of a property, to take massive, massive tax deductions. I mean, probably totally wipe out your entire tax liability, even if you have income coming in from other places. So if you're buying at least one property a year, you should 100% consider doing a cost segregation study and speak to, there's a lot of firms out there that do it, but I know a couple of ones that are really good and IRS audit proof, if you will. You just got to make sure you're working with someone who's a professional. That'll, charge a nominal price and give the information to your CPA when they're done, and it can really, really reduce and offset a lot of taxes. So taking deductions when necessary and not abusing it, but taking all the deductions and really understanding to what level you're allowed to deduct and write off and expense different aspects of the property. And then the cost segregation is huge. If anyone on the call doesn't know what cost segregation is, I highly recommend you maybe go watch a YouTube video on it. YouTube's a great resource just to get an understanding, a base level, foundational understanding of what cost segregation is, how it works, how it can benefit you, and honestly, how it correlates to taxes.
Yes, I agree on that. So, but I just learned, I was thinking to myself, if I have just one property a year, is it worth it? And you definitely answered the question. So I do
Absolutely.
appreciate that. You were kind of reading my mind there. So, okay, well, we're going to move on to um, retirement accounts. How can our people here on the call or myself use our self-directed retirement accounts like a solo 401k or the SDIRA, which is a self-directed, to invest in real estate while optimizing taxes?
Absolutely. So retirement accounts are one of my favorite topics. So I actually, obviously they're used, the name of them are retirement accounts, also known as qualified retirement accounts, QRAs, things like a 401k, an IRA, a 403b, a 457, self-directed IRAs, SEP IRAs. There's probably 100 different names. They're all the same thing, similar structures, just classified as a different code. Now, again, back to the topic of tax deferred versus tax free. When we work at a job, I know, Cindy, you said someone here just left their W-2 job. I believe it was Alina. Sorry, Alina, calling you out, but you don't have to say anything. But someone, left their W-2 job on the call. If they were contributing to a 401k, a 403b, any sort of retirement account with that employer, well, once you separate employment, you now have access to essentially move that money into a different structure, such as a self-directed IRA, such as a solo 401k, such as a traditional IRA. There's many different avenues and options you can take. And the reason that you 100% should have a conversation with me on if you have any old retirement accounts with previous employers that are no longer active, basically meaning you're not contributing to them on a regular basis because you don't work there anymore, you should be redirecting that money into a place where you're allowed to have more control over it. It's all about control. Once you have more control over the money, you can invest in businesses, you can invest in real estate, you can invest in crypto, you can invest in anything, just about anything, through the use of the self-directed IRA. Okay. Converting something from a 401 or a 403 to a self-directed IRA is not a problem at all. The problem is that most people do it and they keep the money sitting in a tax deferred status. When you contribute to a 401k, typically you're putting pre-tax dollars in there, meaning you haven't paid taxes on the money. The government is happy with this because, hey, Cindy's putting in $1,000 a month into our 401k plan. It's growing and earning 10% interest. So she's making $100 on every thousand she puts in. We don't have to have her pay the taxes today. That's no problem. In 30 years from now, Cindy, when you go take distributions out of this account, you'll pay the taxes. The money will have grown to a lot larger amount. The tax rates will be much higher. It's way more beneficial for us to wait and have you pay the taxes later on. That's why the government is so fond of tax deferred strategies for growing and investing money. I don't like tax deferred strategies because, as I mentioned earlier, it creates a larger problem later on. Taxes don't go down, folks. They typically go up. Okay. They typically go
Absolutely.
up. And, so the whole thing, the whole, structure and the whole goal is when you have an opportunity to move money from one place to another, aka 401k, 403b, retirement account, to an IRA or a solo 401, let's convert to a Roth status. And if you guys don't know what Roth is, if you know what a Roth IRA is, that means tax free. There's traditional, which is tax deferred, and then there's Roth, which is tax free. If you have the ability to convert the money to Roth status, all of the interest, all of the gains, all of the growth going forward is 100% tax free. Now, that's an ideal situation. How do you do it? How do you convert from traditional to Roth? Well, that's some secret sauce that I can't give up right at this second, but just kidding, guys. There's a ton of different ways to do it. Well, there's not a ton. There's a few different ways to do it, but we want to do it to where you're not just paying 30, 40, 50% tax and then just walking away with whatever's left. You don't want to do that. You don't, if you're not 59 and a half, you'll pay a 10% federal penalty. If you're in the 30% tax bracket, you'll pay 30% tax. It's taxed as ordinary income. Don't just withdraw it and put it into your bank account. That is the worst thing you can do. Use a Roth conversion strategy, which someone like myself can help walk you through. Doesn't cost you anything. Okay. Use a Roth conversion strategy to turn the money from traditional tax deferred to Roth. And then once it's in a Roth status, go wild. Invest in real estate, buy assets, buy businesses, buy crypto, whatever you want to do with the money, and everything else is tax free. Now, Mitch actually put in the chat as well, infinite banking. So That's another conversation we can have. I really don't want to use this call to discuss infinite banking. Cindy, by the way, if you'd like me to have a separate conversation on that, I can probably talk for 5 hours on that alone.
Yeah,
But infinite banking, everybody, all Mitch means by that is using insurance products, life insurance products. Yes, you can use life insurance for reasons other than just when you die, your family gets paid. Using life insurance products to grow your money and build your wealth and, honestly, just build a tax-free shelter for your money with qualified money as well. So there's insurance products out there that are available depending on your situation and your dynamic where you can basically put your money into, grow it tax-free, borrow against it, loan against it, which is tax-free. When you take a loan, it's tax-free, and then have your money working for you in multiple places at once with no taxes, no penalties, no fees, and no restrictions on what you can or can't borrow, et cetera, et cetera. So that is another great resource. It's basically just, a longer conversation than the time we have right here. But infinite banking is another thing for everybody on here to go look up on YouTube, just to get a familiarity with what it is and how it works. But if you're interested in learning more, talk to someone who does it and who implements it in their own personal situation, like myself, to just see how it would even apply to you, or if it would even apply to you. Just because I'm talking about cost segregation and infinite banking and different structures like this doesn't mean that everybody on the call, it might not make sense for every single person here. You might qualify better for one versus another, depending on what you're trying to do. Okay. Again, I know I keep saying this, it's case by case, but it really is case by case. Cindy doesn't have the same situation and dynamic as Ido, and Ido doesn't have the same situation and dynamic as Mitch, and et cetera, et cetera. So figure out where you're at and where you want to get to, and then let someone, an expert, reverse engineer and get you there.
absolutely. Thank you so much for that. I love that reverse engineer. I
Yep.
don't know if I've quite heard that yet, but I think I needed to start on reverse engineering about 30 or 40 years ago. So I'm glad that we have so many people here to learn about this now, and hopefully we can get started sooner rather than later. The next question I have for you is, how do we ensure that we're compliant when using tax loopholes or aggressive tax strategies?
Okay. All right. Well, I get this question a lot. So, as I mentioned previously, nothing I do and nothing your CPA or advisor or anybody that you work with who's a professional, right, in nature, should be operating in the gray area. Okay. And what I mean by that is Cindy used the word aggressive. Okay. That is probably the worst word that you can use. Not you, Cindy, but an advisor can use to describe a strategy or method. If they use the word aggressive, run. Okay? Because I don't know about y'all, but my CPAs, my tax attorneys, my advisors, they like who they work with, but they're not willing to go to jail for them. Okay? So the simple way to avoid that, follow the code, operate in the black and the white, and don't get into the gray. That's it. That's all you got to do. Like I said, this tax code is 77,000 pages. 95% of it was written for the consumer. 95% of it is loopholes. And I also don't really like that word, but loopholes and cheat codes to basically not pay any taxes. But instead of you going and reading 77,000 pages of tax code, you hire experts and people who know what they're doing and know what they're talking about to help guide you and navigate you through, to basically be your quarterback through the situation. You just decide if something makes sense or if it doesn't, depending on what what you're looking to do. But anyways, the way you stay in compliance, Cindy, is again, working with an expert. Don't try any of this at home, kids. Yeah, I had to throw that in there. Seriously, don't try to interpret things and do it on your own, or and please, 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 please. I'm saying this with so much passion. Please don't take a strategy from Instagram or TikTok or even YouTube. Don't take a strategy like buying your car in a different state to get no sales tax. Please don't use those strategies for your own personal life or business. Because when the IRS comes knocking, or if they come knocking and they want to look into your situation, do you really think that, hey, I saw this on TikTok? Do you really think that's going to work?
I don't think
No. The answer is no. Okay.
because TikTok is sort of a little on edge anyway, right? So
Right. So look, work with folks and individuals who have a proven track record, who have dealt with it, who have implemented this strategy. If it's a new strategy, run. If it's a strategy that you don't understand, run. Okay. Even for strategies that some of my clients have been using for years and decades, and have gone through audits and it's been fine and everything has checked out from a compliance standpoint. Even strategies like that, if I'm speaking to a new person about it and they don't understand it completely and can't repeat it back to me in layman's terms, I won't do it. I won't do it. Not because I'm afraid of them getting in trouble, but I'm afraid that if you can't understand something, how are you going to run your business? How are you going to balance your checkbook? How you gonna purchase things? How are you going to implement the strategy and make sure you're reaping the benefits of it if you can't even understand it? Okay? There are very sophisticated strategies out there. But if your advisor is good and they're good enough at what they do, they'll be able to dumb it down to a level, fifth grade level, if you will, where you can understand it and actually comprehend it, you know? And so my biggest piece of advice is find a trusted advisor, find someone who has a proven track record, who has results, has clients, has references. Make sure that the strategies they use, you know, are can be understood by you. Have IRC reference codes, which means they've referenced the tax code, are not some new strategy, not some strategy based on TikTok, social media, whatever you know, what have you. And just do your due diligence. Just like when you invest in a real estate property, you do your due diligence on who you're partnering with or the property itself. You get appraisals, you get inspections, things like that. Do your due diligence on the advisors that you work with too, because there's a lot of unfortunately, there's a lot of crappy people out there. And sometimes they're hard to identify. So don't be afraid to shop around. I tell all my clients, hey, go find other advisors who are offering different strategies, tax strategies, have conversations with them. If it makes sense to work with them, sure. Maybe we can do one thing and you can do another thing with them. That's fine. But don't ever put all your eggs in one basket and just, do proper due diligence and research.
that is excellent advice. I appreciate that. One thing I heard you say, which I just have to say out loud, is that there's people out there who actually, enjoy and sit around reading 77,000 pages of the tax code. So I
That's
guess we
right.
need to find those people and see what they have to, how they can advise us properly. So thought
That's right.
that's a big number. All right. So, if somebody was just starting out, what is the first step they should take to optimize their tax position if they're just starting out with a business or real estate or something of that manner?
Yeah. So first step I would take is figuring out proper structure. And really what that means is entity structure. So one of your questions earlier, Cindy, was, do I form an LLC? Do I form do I put it in a trust? Do I use an S Corp, a C Corp? Again, it's going to really depend on what your goals are. Are you just buying one property and renting it out to a long-term tenant? And really that's the extent of it, and cash flowing or having someone pay the mortgage? Is that what you want to do? Or do you want to have multiple Airbnbs that, you constantly have tenants coming in and out of? They're all short-term rentals. Your liability is high because God forbid someone does something or whatever, damages what type of business are you trying to run would be the first question. Once you know that answer, consult with an expert to figure out what structure makes the most sense. And ask the question, okay? Does an LLC make more sense and why? Does a C Corp make more sense and why? Does an S Corp make more sense and why? And then how do I use trusts, wills, et cetera, to basically help with, top level planning, estate planning, and asset protection. So figure out what you want before jumping into it. If you don't have a roadmap laid out, well, you're just going to be driving in a bunch of different directions, hoping you get to where you want to go. And then you're going to be disappointed with the result because unfortunately, you didn't have a plan to begin with. And my favorite saying in the world is failure to plan is a plan to fail. Okay. Failure to plan is a plan to fail. I know it sounds cliche. Maybe everybody on here has heard it before, maybe not, but someone told me that about 10 years ago. Because I like to just jump into things and just learn from my mistakes the hard way. And it really sticks with me every time I make a rash decision because you typically get taught a lesson pretty quickly. Whether that's losing money or just failing at something or, getting into something that you're in way over your head, with, you typically get humbled very, very quick when you don't do proper planning. So proper planning can help you avoid a ton of mistakes with losing money and things like that.
Absolutely. Thank you for that. So lastly, what should we ask our CPAs or our tax advisors to make sure we're not leaving money on the table with the IRS?
Yeah, so another great question. So, my litmus test with CPAs is, if you're a high income earner, I would say, typically if you're making 200,000 a year or more, you've now entered tax brackets where you're approaching 30, 40%, even 50% in some cases, depending on what state you live in. And so if your CPA and or accountant and or advisor has you paying 30% or 40% in tax, honestly, that's a problem. And the reason I say that's a problem is because I have clients that make 250,000 and I have clients that make 25 million a year that both pay less than 10% in tax. Okay. And again, it's a case by case basis. Maybe your dynamic will allow you to pay 15% or 18% in tax, right? Maybe you can get down to 1% or 2% tax, but paying 30, 40, and 50% tax is completely unnecessary because there are too many deductions, there are too many structures, and there are too many strategies that are all legal, that are all compliant with the IRS tax code that can help you offset a significant portion of your taxable income. And it's not just taxable income either, it's capital gains as well. When you sell a property or sell a business, you have this lovely thing called capital gains tax. Typically, it's 20%, if not more, depending. If you live in California, you get a 13.33% additional capital gains state tax on top of the 20%. So now you're at 33.33%, which is crazy.
It
And
is. So
50% in tax. So yeah, what I was going to say is, if you are paying 30, 40, 50%, I don't care, 25% in tax, and you feel like maybe you're just not maximizing the amount of deductions and benefits you can take, don't be afraid to have another conversation with a different advisor. Okay. Because different advisor, look, you don't know what you don't know. And I'm not going to sit here and tell everybody on the call, or if someone comes to me and says, hey, my CPA has me paying $100,000 in taxes, I'm not going to say that their CPA sucks. That's not the right. You don't know what you don't know. And unfortunately, a lot of CPAs and accountants are very narrow-minded and they only think about things one way, which is filing taxes, doing bookkeeping, compliance, compliance, compliance. Compliance is one of the most important things with all this. But if they're not willing to do some planning, proactive planning, I'm not talking about wait until December 31st to see what you can do to save on taxes. Having conversations with you in March, April, May, June. Right now, it's May 15th. We just finished taxes a month ago, whatever tax deadline was a month ago. I am in full bloom conversations with almost every single one of my clients on how they're going to offset their taxes for 2025. We're over 6 months out from the end of the year because you need to have the conversations now, or you're going to be sorry later on. So if your advisor is not willing to have conversations with you, early on in the year, not waiting till the end of the year, if they're not willing to do proactive planning, strategy, things of that nature, if they're just giving you standard deductions, oh, hire your kids, Augusta rule, blah, blah, blah. If they're just limiting to that and they're not willing to have conversations on other sophisticated strategies, talk about cost segregation, talk about Roth conversions, talk about 1031 cash swaps. To be quite honest and to be brutally honest, and it's kind of sad, most CPAs and accountants don't even know what those are because it's It's not their wheelhouse. They're there to do the bookkeeping and do the tax filing and the tax prep. That's it. So when you hit a certain level of income, which I'm assuming a lot of people on the call are at this point, or you have assets and real estate and different things you own, businesses, you need, go ahead and keep your CPA. I don't want to do the prep. I don't want to do the bookkeeping work. That's not our wheelhouse, right? You need an advisor as well. You need someone that you can work with in addition to the CPA or the accountant that you work with to provide strategy, planning, et cetera, et cetera. It's not a bad thing to have multiple advisors. It's not a bad thing to have multiple opinions. If a doctor tells you you need, life-threatening heart surgery and you got 1 day to live, I mean, most people would be like, hey, if I healthy yesterday, well, I'd like to go maybe get another opinion. Right? Or that's an extreme example, but you guys get the point. Don't just settle for what your CPA is offering you. And the one thing I'll say too, and I'll leave it on this before we open up the questions, is I understand that a lot of us have family and friends who maybe we are doing our taxes or, CPAs or accountants or advisors because you have a relationship with them, personal relationship with them, business, whatever. So you just choose to work with them. That's totally fine. But if they are not comfortable with you having conversations with other advisors, that's a big red flag. That's a big, big red flag. So that's how I'll leave it.
Well, great. I appreciate that. A big, big red flag. So, it sounds like you have really educated us tonight. And I hope, though, that it has helped people kind of get the wheels turning. And hopefully, we have some questions out there. So, is there anyone who has questions? I know it is case by case, but I still think that Ian could probably give you an idea or point you in the right direction if you have a question. So if you'd like to ask a question, you can just come off mute because I don't see us all running to the question podium here, and go ahead and shoot a question out to Ian. Who wants to go first?
Yeah, guys. And another thing I'll say is, while everyone's putting their questions in here is, if you're shy or, you maybe can't think of a question right now, please, by all means, I will put my contact information in the chat. I would love to have you guys have a conversation with me. Obviously, it doesn't cost you anything. Pick my brain, ask me questions. What did I mean by this? What did I mean by that? What can I do? Here's my situation. You know, um, I would be more than happy to have a conversation with anybody on this call, because obviously you're in Cindy's community, and if you're in Cindy's community, you're in my community. And so I will be including my email, my phone number, and a link to my calendar so that you guys can feel free to book a time or shoot me a text or even call me if that's what's easiest for you.
Absolutely. And I'll be sending out a recording of this with all of Ian's information. Mitch has a question. What is a CLLC?
So a CLLC is basically, it stands for charitable LLC. So from a very top level, without getting too much into detail, what that is it is a structure and it's a strategy that you can use to mitigate and eliminate up to 98% of your taxes, whether that's W-2 income, taxable income, whether that's business income, K-1 partnership income, or capital gains tax. The purpose of it is basically a partnership with a DAF, donor advised fund, also known as a 501c3, where it's a charitable giving strategy and you are able to offset and eliminate up to 98% of your taxes. And I will be quite honest and frank with everybody here. It is not for everybody. It is an extremely sophisticated strategy. I would be more than happy to have a conversation and tell each person on an individual basis what it is and how it works. But I would say, unless you're at a level where you're making four, five, $600,000 a year or more, and you have multiple assets, multiple properties, some retirement accounts, etc., well, it might not be applicable in your dynamic right now today. But I can still tell you about it and share information with it on you and with you and stuff like that. I'd be more than happy to do that.
Okay, great. Tiffany, you've got a question.
Yeah, so part of the women's network that Cindy and most of us ladies have met her from, that network set us up with LLCs from basically like Wyoming, or it was Wyoming at that time, and maybe Nevada, or the um, states
Delaware.
that,
Yeah, yeah.
yeah,
Yeah.
you know what I'm talking about.
I got you.
Anyways,
I got you, girl.
with those accounts, like my CPA doesn't really understand that umbrella account.
Yep.
Um, how is the best way for me to explain that without having to go get another CPA?
Mhm.
Um,
Okay, do you want the answer you're gonna like, or do you want the truth?
well, all of it. Yeah, the
Okay.
truth.
So to be honest with you, Tiffany, you've probably gotten to the point where you've outgrown your CPA.
Yeah,
Okay. It happens. We outgrow our CPAs. We do. When you add additional income, when you add additional resource entities and businesses and assets, sometimes a CPA is just not equipped to handle that.
Sure.
Now, I'm not telling you to leave that relationship. If you like your CPA, and this goes for anybody here, stick with them, stay with them. It's fine. What you need, Tiffany, is you need to consult with an external party, a tax strategist, an advisor like myself, who has access to additional resources and information to latch on to your CPA and have a conversation as a team so that they can service you properly. That would be the better solution, in my opinion, without having to just completely leave the relationship.
sure. Okay.
Yeah.
Yep.
We a lot
And
of us did get advised that way. So
And
I,
Right.
another thing I tried telling people, Tiffany, is you're not a CPA. You shouldn't have to explain how things work to your CPA. That's
No.
like going to the doctor and saying, "Hey, doc, like, no, I think that this is the proper way to do surgery, and this is the medication I should take." Like, you don't go to the doctor and tell them what you should take. Like, no. So you shouldn't have to, but it's okay if they don't know. It's okay if your CPA doesn't know. That's perfectly fine. The tax code is 77,000 pages, but
Yeah.
if your CPA is not willing for you to bring another party into the mix just to have a conversation, well, that is a problem, because when CPAs can talk to each other and service the client together, it could provide a whole lot of value. But if they're not willing to do that, then that's when you should maybe start looking elsewhere.
Okay. Makes sense.
Great question.
yeah, very good question. Does anybody else want to type it?
Keisha, I know you asked how do we get in contact with him. So I did put my information down. So my name, my cell phone number, I prefer to communicate that way. Email, and then my calendar link. So, yep, however is best and easiest for you to communicate, please feel free. And I'll also give this information to Cindy as well after the call, Cindy, so you can send it out in an email separate for everybody that
Yeah.
might have not grabbed it. Yep.
Absolutely. I have it all. I've got all that information anyway.
Awesome.
So I know right where to find you. So anybody else have a question for us? We want to just, let everybody have a chance. And if not, we can take off for the evening, but don't feel like you can't speak up. But again, Ian's obviously very personable and you could just get with him also. So,
Absolutely. Yeah. I'd be
yeah,
more than happy to have a conversation with anybody on the call. Again, if you're part of this community, you're part of Cindy's community, Mitch, you're part of my community. And so I love providing value. I love educating, and genuinely, whether there's a transaction involved or not, I'm not transactional. I'm all about relationships. I would love to have a conversation with anybody here. So don't be afraid to book a time on my calendar, chat with me, pick my brain, whatever you want. I'm very passionate about this if you haven't been able to tell.
yeah,
And I know we see it. I do see another question here, Cindy, from Mitch
right.
and
When is a
someone else
good
on it.
time to set up a trust?
A good time to set up a trust is when you're afraid, or I don't want to say afraid, but when you're starting to think about, hey, what's going to happen when I'm no longer here? And that could be applicable for someone in their 20s. It could be.
Yeah,
Because when you're in your 20s, you might be starting a life. I just got married, hopefully children soon. God forbid, knock on wood, something happens and you don't make it home tomorrow. What does that look like? Especially if you're a provider for the family.
yeah,
So that's when I would have the conversations on setting up trust. getting some insurance, life insurance, having a proper estate structure set up. So in the event of a worst case scenario, someone knows what you wanted to see happen with the assets and the money and et cetera, et cetera. Single mom with 2 kids, have met life with, yeah, I would, yeah, Wendy, I would, yeah, let's have a conversation. I have a couple of questions. Because the thing with the insurance is, that's great that you have a policy with United Airlines, it's fine, but at some point that will be no more, once you decide to leave or once you stop working. So I would look into additional coverage there, but also, yes, 100%. If you're a single mom with 2 kids, God forbid something happens, again, knock on wood. Well, what does that look like for your children? Who is the trustee, who's in there and who's able to basically come in, someone you can trust, whether that's an advisor, whether that's a family member, to basically help with what happens to what you leave behind. So please, book a time, let's chat about it and we can go from there. Yeah, no problem at all. You're more than welcome.
All right. Do we have anybody else? Steve, did you have any questions? I'm putting him on the spot.
He looks like he's got questions.
He's trying to unmute. No, he doesn't. I'm just giving him a hard time. He's here to learn a little bit too. Tiffany, you got another one. Thank you.
Yes. I had another just thought that came across my mind. So I know like you were speaking about the irrevocable trust, but like for me, I have a living trust that, needs updated and whatnot. But with that said, I keep hearing like do this and don't do that, or do that vice versa. Trust, do you hold that real estate in that trust, or do you not hold real estate in trusts if it's a living trust?
If it's a living trust, then yeah, I don't see a problem with it whatsoever. It provides a lot of protection, so it's not a bad idea to have real estate that's held in a trust, a living trust especially. So yeah, simple answer to your question. Short answer is there's not a problem with it at all. But really, what I would ask you, Tiffany, is, and again, we can talk about this offline, but
Sure.
is what do you why do you have a trust set up? What recommendation was that? Was it for the purpose of asset protection? Was it for the purpose of, hey, I want it to be specifically written out on what happens to these properties if I die? Or are there other reasons, right? Because you can maximize the benefits of a trust if you really know about what a trust is and how it works and how to truly, get the tax benefit. There's tax benefits that come with trust that most people who set up a trust don't even know about because they just set it up. Right? There's tax benefits, there's income benefits, there's legal benefits, there's asset protection. I would probably say, hey, you should have the LLC that owns a property in the trust and have the property owned by an LLC and then have the trust own the LLC. That would be a double protected structure from taxes, income, things like that, and legally. But even if the trust alone just owns the property, you already have done way more than a lot of people. And you've already protected yourself significantly from that piece. So.
Okay. But we'll still have a conversation. Okay.
For sure. Yep.
Definitely. I think Tiffany would be good knowing what I know about Tiffany. So, well, yeah, it's all good. So thank you guys again. I want to be respectful of everybody's time. It's 6:58 here in Colorado. Not everybody's on Mountain Time, but quite a few of you are. So that means though that it's probably 7:58 or 8:58 wherever you guys are. So thank you again for coming. I believe I have everybody's email. And I will send a recording and I will send out Ian's information. And again, thank you for coming this evening and we'll see you soon or talk to you soon.
Thank you guys for having me. Thank you, Cindy. Thank you so much for having me. And yep, everybody, I'll hear from you soon, hopefully. Have a great night.
Thank you.
All right. Bye.